And if you think about retailing, you know, it's a bit like in the US when there's Walmart, which has put a lot of small companies out of business, but then there are networks of the sort of small mum and pop stores that band together to fight Walmart. And I guess Metcash is the kind of um, conglomerate of those sort of mum and pop sort of stores. So, okay, Metcash. Yeah. You don't need to check your dummy portfolios to see if you own Metcash before I talk about it, because it's not on the buy list. It's not quite an anti-QAV stock, but it doesn't have a very high score. I think most people will be familiar with Metcash, the company. It is a supermarket, hardware store, and liquor group wholesaler and franchisor, I guess. Operating brands like IGA and Foodland, Home Hardware, Mitre 10, Celebrations, Liquor Store, those kinds of things. So all the Australian listeners will have come across those from time to time and may even use IGA for their weekly shopping or Mitre 10 to do their DIY. Long and storied history, this company, which I always find interesting. The history of Metcash goes back to the early days of supermarkets in Australia, 1927 in Woolloomooloo, when a guy called Joe David opened his first store and called it David's. And David's supermarkets were around for a long time in Sydney. So that was 1927. 1935, Joe David opened a warehouse in Redfern to supply his stores, but also saw the opportunity to supply other stores as well. So basically started the wholesale supermarket supply business in Australia. So the fast forward to 68, and David's expands into liquor. 1980, they had a big acquisition, a company called A.G. Campbell's, which was a large supermarket wholesale business in Australia. And then in the 80s, they were the first to introduce scanning and labelling to Australia. 88, they introduced the retail banner Independent Grocers Alliance, which is, of course, IGA. And in 2000, rebranded as Metcash after South African company Metro Cash and Carry took a major stake, and they stayed with them in only about 4 or 5 years and then sold out. 2005, Metcash acquires Foodland Associated. 2010, they acquire Franklin's and convert that brand to IGA. And then they start to branch out into other areas, including hardware. So in 2010, I hesitate to say acquired, they did a deal with Mitre 10. So because they're a wholesaler and franchisor, I'm not quite sure acquiring is the right term. They basically sign up companies and come under the stable of Metcash Supply, and then convert to franchise arrangements as well occasionally. And I think that was a smart move, because the supermarket wholesale game's a tough one. There's, of course, 2 major competitors, 3 really if you count Aldi, Coles, Woolworths and Aldi in Australia. So it made sense for them to diversify a bit into hardware and liquor. And they've certainly kicked some goals in both of those areas over the years as well. What else can I say about them? So I guess the point I'm making is essentially they're a wholesaler, but they do have some element of control over brands, sometimes as a franchisor of the retail outlet, sometimes as a part of their wholesale deal. They'll do store refurbs and refits, and sometimes they actually operate the outlets. The other thing to note is that I think today they came back out of a trading halt, but they've just raised $300 million to acquire the food distribution company Superior Foods, and that's a business that supplies cafes and restaurants. They're also using some of that fund to acquire a couple of hardware suppliers, Bianco and Alpine. And that's basically been the history of this company in the last, say, 20 years. They either take on debt or raise capital and then go and consolidate in the industries. And if you think about retailing, it's a bit like in the US when there's Walmart, which has put a lot of small companies out of business, but then there are networks of the sort of small mum and pop stores that band together to fight Walmart. And I guess Metcash is the kind of um, conglomerate of those sort of mum and pop sort of stores. So, for example, on the hardware side, with Home and with Mitre 10, and recently with a company called Total Tools, which is number one in its market of providing tradies with professional tools. I can see you smiling. And but I was talking to an insider from the hardware business recently, and they were saying that Mitre 10 and Home Hardware and Total Tools can do really well up against Bunnings because it depends on their service and the store layout. But for example, oftentimes they'll open it across the road from a Bunnings, and then the tradies will go across to the Mitre 10 because it's got a bigger trade supply section and does better service. Or they might have a bigger paint section than the Bunnings, or the staff are just better, and it gets to the point where in the paint section in the Bunnings store they'll refer customers across to the better service at the Mitre 10 across the road. So they've kind of grown symbiotically almost off Bunnings as well. And because Bunnings is the category killer, you wouldn't expect another hardware chain to do as well, but Metcash does operate the number two hardware chain, the combination of Mitre 10 and Home Hardware and Total Tools. And the other area that Metcash has gotten into with the hardware stores is that they put them into, urban areas. So, for example, there's one up the road from us on Oxford Street, which is not where you'd expect any tradies to go because there's no parking, no real floor plan. It's kind of like 3 stories of hardware, and they call them grab-and-go stores. So they'll stock things that a very meager DIY person like myself might want to go and buy, a picture hanging frame or a picture hanging set or a drill or something like that. Just grab and go stuff you can carry home with you. So that's a good niche market for them. So they've kind of filled all the gaps that Bunnings can't survive. There is talk as well of rural areas, for example, that the established hardware stores there are able to lobby the councils to keep Bunnings out of, and they're successful in those kind of areas as well. Don't know how much truth there is into that, but it certainly goes on. So that's the kind of Metcash story. To go through their numbers, and again, it's not on our buy list, so be aware of that. The stock price I'm using is from a day or two ago. It's $3.64 is the share price. ADT on this company is $9.3 million, so it's very big enough for most people to buy into. But the share price is currently at Josephine. It's one of those ones where the buy line and sell line are starting to converge in a triangle. So it's above its buy price, but it's almost at its sell price, which is $3.52. So not too much above that. The share price is above consensus target, but it's less than consensus target, but it's a long way above IV1 and IV2. IV1's $1.51, IV2 is $2.74. The yield is 6%, which is good. It's high, but it's not good enough because we want it to be 6.8% or better. Stock Doctor Financial Health is early warning, which I thought was interesting. And it's consistently been early warning for a long time. So that's not a stock I would like to necessarily own, because early warning isn't as financially healthy as Strong or Recovering or some of the other ones that are there. But I'm wondering whether, because it's a wholesaling type model, that early warning is just how it operates, because it's not like a supermarket necessarily, where supermarkets like the ones that Coles and Woolworths run are terrific businesses, because generally people shop once a week, so you're getting paid once a week for your stock, but you're paying your supplies once a month. So you've usually got this tremendous amount of working capital sitting there to be used in supermarkets. I don't know if that's the case with Metcash, because they're not selling. The retailer is selling the stock, they're supplying the stock, so they're being paid monthly and supplying and invoicing monthly. So I'm wondering whether early warning is a sort of natural part of being a retail wholesaler, but I haven't done a deep enough dive to look at that, but I'll call it out. And the financial health is steady because it's been early warning for a while. PE is 12.3, which is almost the lowest, but not quite, so we can't score it for that. PropCAF is 7.15 times, so it's above our cutoff of 7, but getting pretty close to being acceptable, but not at the moment. Net equity per share is only $1.16, so it's much lower than the $3.64 share price, and therefore we can't buy this at anything like book value. And again, a sidebar to NEPS for this company. Net equity per share is $1.16, but the net tangible assets is 24 cents per share. So there's lots of goodwill through acquisitions on the balance sheet. And as I said before, they're making their business plan is to consolidate all the fragmented retail operations around Australia. So that's not unusual. And as people will know from past podcasts, I'm not necessarily against that kind of goodwill acquisition on the balance sheet. There is the risk that they have to write something down. But the flip side is if you look at the acquisition of, say, Total Tools, which was their last big acquisition, they've kicked some goals with that, and I think they've doubled sales in about the last 18 months since they've acquired it. So even though there's goodwill on the balance sheet through acquisitions like that, if the companies underlying it are doing well, then it's worth it. Stock Doctor has forecast earnings per share growth of -3%. So that's something we don't like to see. So it gets a negative for that. There's no owner-founder, and equity hasn't been consistently increasing. So there's not a lot to score on the quality side of things for this company, and it gets a 4 out of 16 or 25% score. And if you divide that by the PropCAF, it's a QAV score of 0.03, which is well below our cutoff of 0.1. So interesting company to look at. Strengths and weaknesses for it. I like the hardware business side of things. I think that was a great idea to diversify into hardware because they're the number 2 player in hardware, which is a great space to be in, but they're the number 4 player in food, which is not a great space to play in. And plus they're the wholesaler of food, so they're not getting the normal benefits of a supermarket of this kind of free working capital because of trading terms. So made sense for them to diversify away from that. Some of the other strengths, they really have embraced the local store strategy, both in their supermarkets and other businesses. And they do try and make themselves the centre of the community, often particularly in rural areas, but even in urban areas, they do a lot of community support and outreach and things like that and sponsor local activities. So they try and play up the community side of things. As I said before, the hardware is working well against Bunnings. Liquor is number 2 in its market, so that's also been doing well. I think the other strength for them is that they're still consolidating a fragmented market across all these different categories they operate in, and that'll come to an end at some stage, but they're calling out there's still plenty of opportunity there, so that's a strength for them. On the risk side, or the weaknesses side, I really think the food side is the biggest risk. Coles and Woolies have done a lot of experimenting with small footprint stores like Coles Express, and I forget now what the Woolworths brand is. It's Woolworths Metro, which must be eating into IGA's territory. Aldi has also a similar sort of strategy to IGA, so that must also be competing strongly against them. So I see food as being a tough business to be in, and then the 4th largest in food. So retailing is all about having a competitive price, and if you're the 4th largest, you're not going to get the best trading terms from your suppliers. So they do have to play up the convenience side of things because they'll never get down to match the majors, I don't think. So that's going to be an issue for them. I think branding fragmentation is an issue for them, and that might be solvable over time, but they've got some stores as Foodland, some stores as IGA. I think some are Super Value. There's quite a lot of different brands in the market, and they could probably benefit from having an overarching brand, which will then get some recognition or better recognition and stronger values associated with it. They're going through a major IT upgrade, which is always difficult, especially for it's a big company, but not the biggest in the area, so a smallish retailer in Australia. So that there could be some risk with that. I put a question mark on the franchise model. I worked in the franchise system at Shell, and it's a tough one because you are always herding cats to try and do what you want. you see it as being best for the franchise, but in some local areas it may not be, and then it's an exercise in negotiation over trying to get the local people to toe the line and adopt the franchise standards. So that's always a difficult business model. Just to highlight the difference in sizes, so total revenue, and I know it's not an apples to apples comparison because Metcash has hardware as well as supermarkets, and Coles has Target as well as supermarkets, and Woolworths has Kmart, etc. But total sales, the headline comparison, Metcash does about 32 billion per year. Coles has 80 billion and Woolworths has 126 billion. So that kind of size disparity will eventually make it difficult, if it hasn't already, for Metcash to do good deals with suppliers. And I wouldn't be surprised, I'm not going to suggest this, but I wouldn't be surprised if Metcash can't even access some suppliers because Coles and Woolworths have somehow tied them up. But I don't have evidence for that, but wouldn't be surprised. The Stock Doctor financial health of early warning, I think, is an issue. Again, that could be just the way the model works for this industry, but certainly when you look at all that goodwill on their balance sheet and 24 cents per share of net tangible assets, that's saying to me they don't have much space to borrow for acquisitions. They've just come out of a trading halt today to raise 300 million for an acquisition. So I suspect if you're a shareholder in this company, and they're growing by acquisition, you're going to be asked to stump up money from time to time. So just take that into account if you wanting to buy into this one. And the last risk I put on my list is a government inquiry, which has been announced into the supermarket industry, and whether there's price gouging going on and whether they're doing enough for the cost of living crisis, blah, blah, blah. And most reporters and most people are saying, oh, this is going to be tough for Coles and Woolies. But I lived through one of these inquiries just before I finished working at Coles or Coles Myer back in the, when was that? Early noughties or mid noughties. And the person or the company that came out the worst from the inquiry was Metcash, because Coles and Woolies were able to, at least in the short term, make a case to say we've dropped our prices, we're doing the right thing. But Metcash just couldn't afford to. And they constantly kept pointing. Every time they went in front of an inquiry panel, they'd point to the fact that they were cutting prices, but the other player in the market wasn't. And so I don't think Metcash ever faced any sort of government sanctions or penalties, but certainly got a fair bit of bad publicity out of an inquiry like that. They're just not big enough to fight it, whereas Coles and Woolies are quite adroit at doing that. And I suspect the same thing is a risk for Metcash going through this one as well, which is about to start. So that's Metcash.
There you go. Thanks for that, Tony. That's for John, who requested that last week. Not sure why, but gave us something to do. So thanks, John.
Yeah.
Metcash. Is it a likely anti-QAV stock, Tony?
No, because I think the anti-QAV stocks are all growth stocks, and Metcash isn't a growth stock.
It's just
muddling along.
Yeah,
May come on the buy list. I mean, the prop cap for it was 7.2 or something, so it's not too far off our cutoff. If it can improve the quality score, it might get on there.
Could get up there.
Yeah.
All right. Thanks, TK.